I always get excited when I hear that music because it means it's Friday and it means it's time for Risk and Rewards with John Authers and myself, Lisa Abramowicz, where we take a look at the most important themes of the week. This week was a bit muddier. There were a lot of different narratives kind of being woven together. But from my perspective, it really underscored this big question, which is rates traders seem to be pricing in 6 full rate hikes through year end by the Federal Reserve. Have equities really come to that realization, and even credit for that matter?
That's a fascinating way of framing the issue, Lisa. And I guess, you wouldn't be asking if you didn't think the answer was no. But I tend to agree with you that
it could be either way. Keep calling me out.
This is the kind of pivot that's happened in the Fed's messaging, and which has been recognized by the bond market. Given how hugely overextended the stock market has been, given how much obvious excess has been caused by the liquidity that was released 2 years ago to deal with COVID, it is remarkable how little the market has sold off, and the low from almost 3 weeks ago now is still holding on the S&P 500 and so on. There's no great. It does strongly imply that traders aren't totally aware or haven't thought through what 6 rate hikes will be, or that the equity market thinks the bond market is wrong.
Right. So you said you think that I obviously would think that the market has not priced it in.
Yes.
There are 2 ways of thinking about this, and I don't know the answer because earnings have been incredibly strong. You've seen a lot of robust reports. Yes, earnings estimates for the rest of the year are coming down, but still it is a pretty healthy, I would even go so far as to say very healthy economy according to a lot of metrics. There is an issue of, if markets are not rattled by 6 rate hikes, does that mean that the Fed has to go much faster to really transmit their tighter policy to the economy, right? So that's one side of this. If the market is pricing this in, then perhaps the Fed needs to be even more aggressive. And that's some concern that I see. And it's not just with equities, it's also with credit. Even though you see credit spreads widening, they're still very low. Even though you see mortgage rates that rising to the highest level since 2019, they're still below 4%. This isn't enough to really create slam the brakes on an economy that otherwise looks pretty hot.
Yeah, I can only agree, particularly on credit. It's very intriguing. Yes, spreads are the widest in a matter of months, but there's still nothing to write home about at all in the historical context yet, given that the kind of scale of rate rises we're about to get would normally be expected to really change the dynamics in the credit market. I think if you take a look at stocks and earnings, you do have this rather strange position where the better the earnings, often that means the higher the margins, which means the greater the pricing power, which means more inflation, which means potentially more rate hikes at the end of the equation. This is one of the first earnings seasons I can remember where people actually have been analyzing the earnings very directly for a completely different macro point of view, which is, what does this mean for inflation? There is that.
And that's actually a fascinating point, in particular, because you do have a situation where people are looking to equities as a hedge, and you're seeing massive bifurcation. You've seen Facebook just had its legs kicked out from under them, and you have the likes of Zoom and the likes of Peloton and Roblox, all the same kind of narrative, but you're seeing others really gain exactly on what you're talking about. So this actually speaks to a certain sense of reasonableness with the pricing, especially given the sense that sentiment's actually pretty bearish, which usually is a contrarian indicator to something more positive.
Yes, I mean, the sentiment is the one thing that I have to admit I don't understand, and that a number of people have been concerned about. A number of people whose research I read, that if you believe the consumer confidence data, it's we are at the kind of levels that you normally get during or immediately before a recession. People are very unhappy. The numbers have dropped very significantly, which is very strange when people are also picking and choosing whether they choose to go to take a job and so on. And as we can see from the retail sales data, they're still buying a lot of stuff. So it's very difficult to reconcile. And similarly, yes, the AAII data suggests that a lot of retail investors now feel thoroughly cowed and nervous about what's moving forward. I.e., that would suggest that the Fed's done its job, that it is getting animal spirits to go back in the jar. It's a very hard one to reconcile. One way to reconcile it is that there are risks of recession are being perceived to rise.
And a lot of people are raising this issue with particularly the back end of the year. How much are we going to have a growth scare? And you're starting to see that kind of narrative percolate into a lot of analyst reports. There's a much more here and now that has resulted from some of these concerns. And that is the vulnerability, to some sort of exogenous shock, right? Something that we're not looking for. And I say this in light of the Russian-Ukraine conflict, which was dominating all the headlines and the market action, just in the jittery moment-to-moment kind of feel in the tape. And it struck me, what does the Fed do with all of this particular concern? Let's say Russia does invade Ukraine. It does become a real focus. Let's see oil prices increase. The Fed's not going to not hike rates because of that, even if the markets sell off, right? I mean, it doesn't mean that. In fact, they might be induced to hike rates more, as some people are pointing out, because oil prices will induce more inflation. There isn't the Fed put, and the Fed can't come to the rescue to a market beset by inflationary pressures. And that, I think, is really underpinning the volatility, the jitteriness in the overall market. And frankly, why things could swing so much either way in terms of steady growth and a sort of, threading the needle of a normalizing market versus, a real hard landing.
Yes, I think that's a beautifully straightforward way to look at it. You do have this issue with the interplay of the Ukraine story, which plainly is an enormous story, and would, if we actually get an outright military invasion followed by sanctions, that's going to change a lot of things. What is intriguing is the way that actually pushes down treasury yields, because you do get shelter flows here. So very perversely, even though one can only assume it would be pretty bad for the equity market, it, not just through the oil channel, but also through the bond yield channel, it gives the Fed an extra incentive to raise, to tighten, because the bond market is no longer doing its job for it by the longer yields are reducing. So that adds an immense level of complexity, particularly as judging that risk requires geopolitical knowledge and so on, which most of the people trading in bond markets don't feel themselves ready for. But yes, the bottom line: Ukraine is something the Fed cannot protect, financial assets from really at all. And I think the way you frame that is very apposite. That it does mean that you get higher volatility, higher levels of concern.
Well, and we got the Fed meeting minutes this week, and JP Morgan Asset Management pointed out that they mentioned geopolitical concerns several times, and that actually the manner that they referenced them was always with potential further inflationary pressures. It was not as a potential risk to markets and the economy, which it also could be. And, we're also seeing increasing numbers of reports coming out and saying, what happens if oil gets to $100 a barrel? What happens if it gets to $150 a barrel? When does that become something that really foists the market into some kind of tizzy? All of these risk factors. And I know I'm accused of being Debbie Downer. And I know that I'd sort of, genetically imposed in me that I look at the worst case scenarios, because that's frankly, again, my genetic composition. But I think that, going forward, all of these potential risk factors don't have the buffer that they once did. And then people point to the buffer of earnings as the main one, which is still there. So, that sort of explains this tenuous nature right now and lack of conviction in markets.
Yes, I think That's right. Again, I think when you look at the earnings channel, again, you've got to bear in mind there is also this pressure on the corporate sector, which does get somewhat politicized in terms of how much how much they can exert their pricing power. One other point that's slightly intrigues me that we've learned a little bit more about in the last few days is that gold no longer acts as an inflation hedge. It isn't particularly responding to. We've had remarkable moves in real yields, which are normally the great driver of the gold price, and they haven't had an effect. But people do still seem to think it's the place to shelter when they're worried about the geopolitical situation. That there's a rise there. So that I think is another part of the equation that's quite difficult to miss. That those levels of that you're getting back to a classic regard of even gold as a haven.
So, John, what ideas really caught your attention in terms of making the most sense as to where people are finding value right now? Because I've heard a whole range of things, and what's caught your eye?
Well, I think again, it's not stating the obvious to some extent, but I think the move into value really does have legs, and it makes eminent sense, i.e. into cheaper stocks. Whatever is cheap is getting attention from the markets at the moment, rather than any of the other things you might regard as offering a shelter. I cited some numbers from Credit Suisse this morning, that if you divide the stock market both in the States and elsewhere by PE, low PE stocks are up a bit, and all the sell-off effectively is in high PE. If you're Facebook or you're the funds in the companies in our innovation, which are look very expensive on a PE basis, there's just not going to be any mercy. That does lead to and this is part of why the stock market isn't as badly wounded as it might be. Value is very good value. I mean, this is a point that all people like Rob Arnott or Cliff Asness have been making this point for a while. And they may be talking their own books, but it is actually true. So there is still a long way further for that to go of money that can, in the first instance, rotate out of not only the pelotons but even the FANG type stocks and into quite a range of stocks that still look cheap. So at a conservative level, I mean, I don't think buying cheap stocks is necessarily going to protect you against some of the worst scenarios that are out there, but that does make eminent sense. There's been lots of imbalances within the stock markets, and that does present opportunities.
That's something that I've heard a lot. Recently, I've heard a lot of people just in the broad asset allocation talk about moving away from U.S. equities. I've been hearing a lot about that. And then cash. I mean, how many people just keep coming on and saying, look, cash is a great optionality hedge, right? This idea of how much you can potentially pounce on certain opportunities. And then you've got other people saying, really? I mean, right now, this volatility is not going to change. And there are places, as you say, that do look underpriced. There are these pockets of differential. I think it's important what you said about gold. I thought was really interesting. But it's the lack of conviction right now is just dramatic. What are you watching heading into the weekend for next week?
I'd quite like to know whether Russia invades Ukraine. That will matter quite a lot. I think it's fair to say. Beyond that, I do think China is always. It's never safe to ignore China at this point. I think, bless you. I think the arguments about whether China really will start to pivot in the opposite direction to the West and actually start reflating this year are very interesting. I think, but I don't know. I think that Xi Jinping is enough of a small c conservative that he wants China's economic house in order and wants to make sure they don't have their own Lehman crisis. But I might well be thoroughly wrong about that. The other thing though, that's moving on from China, if you take a look at emerging markets, this is another thing I don't totally understand. But emerging markets are beating developed markets this year, which is not what's supposed to happen when yields are rising in the West. There's at least a suggestion that they have actually hit rock bottom, that there is now something interesting in buying into places that provide resources. That is another trend to watch very carefully.
Well, thank you so much for watching, and thank you as always, John.